Hello, hope you're doing fine and welcome to our YouTube channel. Today we want to look at the trading channels and also the trend line. So what is a trend line? So when you talk about a trend line, it is a line, a horizontal line that is connecting one price action to the next price action. And this trend line will give us the general direction of where the market is heading to. So there's a trend line and also there's a trend channel. The difference between these two is that the trend line is a single line, while the trend channel are two lines that are moving directly or parallel to the other one. So we have two types of trend lines or channels. That is the upward sloping line and also the downward sloping line. So when we talk about the upward sloping line, it is a line that indicates to us the bullish direction or a bullish, that the market is heading on a bullish direction. And this type of trend line would be called a bullish trend line or a bullish channel. So a downward sloping line or trend line is an indication of a bearish market, and this trend line will be called a bearish trend line or a bearish trend channel. So how are we going to draw the trend line? First of all, you ensure you connect one swing high to the next zone or swing high and swing low. And when the market has touched your line 3 times, it validates to you that that trend line is being followed by the price. We are going to look at this illustration in a minute. So when you find the trend line, you want to see the trend line where the price respects the most. And when a trend line is respected the most, it means that trend line is having a very high impact on the price. So when you have two swing points, that is the dart is always the strongest. The third touch on your trend line will be the strongest reaction to the price, or you will have a strongest resistance when the price gets there. Also, when you are dealing with the trend line, remember the market will touch at some point, and at times it is not always 100% accurate. So on the fourth touch on your trend line, do not trade, because at times the fourth one may fail to be respected by price and it may lead to losses. Also, we have to know that when a trend line is broken, we have to wait for it to reset before setting into the market. So we want to look at this trend line. Let's look at the trend line with the trend channel. So like the example that is right now here is a channel. Why do we say it is a channel? Because we have two lines that are parallel to each other. And as you can see here, the first picture, channel is an up channel or a bullish channel. So meaning the price is moving, touching the channel, then slopes down, moves again, touching that channel, then slopes down, tie that channel. And then now, as you can see from this line here, it failed to come back to this channel. So with this channel, the line that is on the top will be acting as our resistance, and the line that is on the bottom will be acting as our support. So the line that is on the top will be acting as a resistance, and this line that is bottom here will be acting as a support. Yes, this one. So this one will be acting as a resistance, and this one will be acting as a support. Yes. So this down channel here, as you can see, this is a down channel. We have two lines. This is the resistance, and this one is the support. So as you can see on the top part here, the price touched this line first one, and also it touched this one the first. So you can see, we want to validate the statement that we had made. So let's look at this up, the support. So as you can see, the price came, touched this one, first one, then it moved away to this one. It came back, touching the second one. It moved and it came touching the third one. So as you can see, on the third touch, it is the strongest reaction. As you can see, the price moved away from our channel, and even it went and broke that channel. See? So the third touch is always the strongest on the market when we are talking about the resistance, the channels. So let's continue also to see here this one. So the market moved up like that. Let's look at this one, the down channel here also again. This is the first touch on our resistance line. Then also this is the first touch on our support line. The second touch here, as you can see, the price went high, came down here, it went high again, and it came down to this place. So you can see this is the first touch also on the bottom one. Then the second touch is here. Then it dropped a little bit, but it did not reach this zone. So these are first touch, second touch, third touch. So you can see the third touch, there is a very strong reaction on the price. Now let's look at the bottom side here. This is the first touch, second touch, third touch here. Look at how the price behaved. After the third touch, the price rallied up. So as you can see, it is always very difficult to make profit on the fourth touch, but you can make a lot of profit on the third touch because many people are not aware about the channel that it has been respected the third time. And on the fourth time now is when very many people now are rushing to see, hey, it has hit the first one, it has hit the second one, it has hit the third one. I'm waiting for the fourth hit. And as you can see on the fourth one, it fails to occur. You see, let me take you to a whiteboard here. Is a whiteboard. I want to let's assume this is our channel. Let me clear that. And we take that as our channel. This also is our channel. So we have this touch here. This touch here, the market came down, touched this zone, it went up, came down, went up, came down, then we have a sharp rally in price. So you can see when the trend line, the channel was drawn, the price came the first touch, hit second touch, hit third touch. So you can see at the first touch, you will not be trading because you are not aware how the market is going to behave to that zone. And also you cannot draw this channel without connecting it to the next zone. So the first one, you are going to do nothing. Then the second one, now you are able to draw your trend line. You see, you cannot be able to, because you have now this point to connect the price of this point to the next point. But when this point has not been created, there is no trend line until you now find this zone is where the price retests the most. So when you have the first one, then the second touch, the third touch, now you can trade because it will be the strongest. You can see the price came, reacted on that third one, and went down. Now let's look on the support side. There was this first touch, then we had the second touch, and we had the third touch. So you can see you can be able to trade on the third touches on price. You can be able to trade on the third touches of price. Now, let me give you another example. I want to look at this example. So the price came down to that zone, and then after hitting this one here, I want to introduce this another zone like that. Let me delete this. Now you want to see the price was at that zone. So you want to see how the market could be behaving to this area. So this is our resistance and this is our support line. So the price hit first hit, then it went down, hit second hit, it went down, third hit, it went down. So on the fourth one, it may, at times it may occur, at times it may fail to occur. So if it occur, well and good. If it did not occur, then can just go on with other trading options that will be appearing to you. So these are first hit, second hit, third hit. You can now be able to trade from this one sell up to this zone. Now also on the bottom side, first hit, second hit, third hit, you can trade this. Okay. So for you to find the take profit, it is very hard to determine which zone is going to be your take profit, because if the price slows down here for some time and it comes, it will hit this zone, but your take profit will be small. See, so always when you want to take profit, always risk one to get two. So if you are risking, your stop loss is 10 pips, ensure your take profit will be 20 pips. That is the best option to do so that you can realize the profits. So we are going to head to the real market right now so that we can be able to see how the price behaves. So we are going to look on the Euro Australian dollar. We are going to look on this Euro AUD. So this is going to be our trend line. So if you are using tradingview.com trend line, you just come to this corner here and you click on this, you will find trend line, arrows, row, array, all these types of tools. There are very many if you are using a TradingView. So if you want a trend line, you just come and pick a trend line and now you draw. So this is the first zone. You will not do anything until the price come and draw the next zone to you here. So now when you have this next zone, you can now be able to, you can now draw your line. So these are first touch, second touch, third touch. So what could you do here? On the first touch, you could do nothing. So here, you just were seeing what the price is going to do. Then now on the second, you have now find a place where you can plot areas where the price, where you want your trend line to be. So this is on the second touch. And on the third touch, you can see on the third touch, the price hit it and it went down. So you could sell here. You could be a seller here. Now let's look on the bottom side when the price was at the downside here. So this is the first zone that we want to see. Second one. So let's connect like that. So we are connecting to this area here. So now let's look. Here we have this first hit, second hit, third hit. But now look, the price went to this zone, and now we have not seen a very rigorous activity. So, but what can we confirm? This line has been broken. So it means to us there is change. The price is now going to go up. And now we are not going to make any conclusion until we see now this price here. So you can see these are first zone. So we don't know the next zone is going to be where. So we want to see this price going up like this, reaching this area, come down, going up like this, reaching that area, and come down. So that we can have now a place where we can connect this high to the next high, and also we can connect this low to the next low, like that, like that. See? Yes. So that is it on the channels. That is it on the channels. So when we talk about the channels is when we are dealing with two lines. But when we talk about a trend line, is a single line. Like whatever I just, like what I drew here was a channel. So I want to show you a trend line alone. So we can change the pair that we are looking at. Well, let's look at the GBP US dollar. GBP US dollar. So when you are using a trend line is when the market is not respecting both sides of whatever you are drawing. So let's look like at this area here. You can connect something in like that. So as you can see at this area here, the price is not respecting is not giving us a parallel line. As you can see, the price is not giving us a parallel line here. Because of what you can see, let me just connect it very well, at least three touches, yes, like that. So we have, as you can see here, this one, it looks like a triangular line, something like that. So we will not consider that zone, this zone here, as our channel, because a channel has to be two lines that do not meet. Let me just use this example here. This is a channel. The channel has to be two lines that do not meet, so they are parallel. So if I draw this, I will want the next line, you can see, I will want the next line not to meet at infinite time. So you can see here, as you can see, the price, this line came down, it closed below. So meaning that one could not validate this channel. This trend channel. So we will use a trend line here. I'm going to use a trend line. Now on this trend line, we will see the first touch is here, second touch, third touch, the price went, it came, fourth touch, the price went down, it came, fifth touch, the price went down, sixth touch, the price went down. So you can see until it reaches a point where that trend line is broken. And when that trend line is broken now is you want to see the price coming back to test what? That trend line. You want to see the price. So if that trend line has been broken like this by the price and it has moved up, you want to see the price coming down to test that trend line, and then now you can have a move. So this is when you can buy at the breakout of a trend line. You see, I hope you are understanding. As you can see here, that is what was happening on that pair. Let me also connect this zone here. As you can see here, this is a trend line. So I'm connecting from this low to that low to this low to those lows. As you can see, this area we cannot connect on the top side because we have this, and then that one, this one, that one. So you can see the only zone that we are able to see a reaction is this line here. So we have the first touch, second touch, third touch, fourth touch. Remember, at times you may not find the fourth touch, but you also say if you have three touches that has confirmed that zone of yours, at the third touch, it is good to, if it is like for this one, this acting as a support, it is good for you to buy. So you can buy at this one or at the next one. So if your risk is 10 pips here, your stop loss is here, your take profit should be at least twice. So your take profit could be at this zone and your stop loss this area, and it could be hit. You see. Now let's look at the current place where the price is right now. You can see also at this bottom side, it is being respected. This bottom line, it is being respected. Now let's look at the top part. Let me use the real channel. Let me use the real trend channel. Just come to that place, pick parallel channel, and you connect it like that, and now you move up. So as you can see this area here, this one, let me now zoom it. When we can go to 15 minutes so that we can see clearly what is going on. Now, when we are at the 15 minutes, let's look at this zone. The price is playing around this channel. So there was this first touch, second touch, third touch. So on the third touch is when you could buy. Now let's look at the top side. First touch, second touch, third touch, fourth touch. So when the price touches that zone, you sell, and your take profit should be at least twice your stop loss. Yes. So we want to look at the next topic. We are going to skip the Fibonacci levels. and we want to look at the trend. What is a trend? What is a trend? So a trend is a tendency of price to move in a particular direction over a period of time. Let's say day, period, like 1 month, 4 hours, 15 minutes. That is at that particular period of time. So a trend can either be an upward trend, downward, or a sideways trend. So with these types of trend, when the market is, so these types of trend will lead us to a market structure. So, but before we go there, let me just try to show you what we are talking about, the trend. A trend, and they have said that trend, we have downward trend, we have the upward trend, and also we have the sideways. We have the downward, upward, and the sideways. So what does this mean? So an upward market is when the market is moving upward like that. So this is a bullish market, or also you can call an upward trend, or a bullish trend. We can call it a bullish trend. Let me just draw very well. So the market move up, comes a little down, moves up again, comes a little down, moves up again, like that. Let me just draw using a single line. The market move from that low to this high. So this is an upward trend or a bullish trend. The market move from this low to this high. So this is a bullish trend or an upward trend. Then when the market is sideways is when the market is neither moving up nor down. It is just playing around like this. It is just playing around. So this is called a consolidating market. It is neither moving up nor down. It's just playing sideways. So that is a sideways market. Then we have this market that is going from this high to this bottom side. So these are downward market or a bearish market or a bearish trend. So we have this trend. So this is a bullish stroke upward. Then we have the sideways here, stroke consolidation, sideways stroke consolidation. Then now we have this downward trend stroke bearish, well, the bearish trend. So this is what we have to know. But now this information, the bullish, the sideways, and the downward market will lead us now to what is called market structure. We want to learn the market structure. What is the structure that is going on? Because that is very, very key to us. So we are going to go to market structure. A trend is going to lead us to market structure. So, and we say a market structure is the continuous series of higher high and higher low when the market is on a bullish direction, or a continuous series of lower low and lower highs when the market is on a bearish direction. And when the market structure is non-relevant and there are no highs or lower lows, that is when the market is neither moving up or down, and it is a sideways market or a consolidation. So market structure is relevant on all time frames, but all time frames will be showing us different market structure. If you are looking at the market structure in daily time frame, it will be different with the market structure that you'll be looking at in 5 minutes time frame, because the information happening in the daily time frame will take the entire day to be represented by a single candle. But how can you compare the information taking place in 5 minutes being represented by one candle. Meaning, if you are using 5 minutes and you want this 5 minutes to give you the same information as the daily, it will not make sense, because one day will be carrying 5 minutes times now the number of candles that are going to occur. So like for instance, if you are looking at the 1 hour time frame, the 1 hour time frame will take for 24 hours to be a day, it will be requiring 24 candles for that day to close. So it will not make no sense if you want the daily time frame information to give you the same information as the 1 hour information. Those two markets are different, but the objectives will be the same. Why is it so? This is due to the fact that higher time frame overall market structure may be up, and lower time frame market structure may be current downtrend, as the market is bulling back, waiting for next influences or influx on buyers to continue the market movement of the higher direction. So if you are dealing with the market structure, it is very, very important to understand the time frame that you'll be dealing at. If it is a 15 minutes time frame, 30 minutes time frame, it is very, very key to understand what structure is occurring in that time frame before even you go to the next time frames. So what are the types of the market structures that we can look at? So we have the bullish market structure, bearish market structure, and the consolidation. And the consolidation structure. So when the market is at the consolidation, there is no big activity, just the market is just playing around. So we want to look at the bullish market structure, the bullish market structure. And when you say a bullish market structure, it's a market that is creating to us a series of higher high and higher lows in the market structure. So we can identify this series by seeing at least two sets of series of higher high and higher lows in our charts. So we want to look at that example, and then now we can come to identify this in our real chart. So let's look here. Let's look at this zone here. The market is at this low here, and this market moved up to this high here. So as you can see here, previously the market was moving from this high, it came to this low, then went to this high, came again to this low, went to that high, came again to this low here. So when the market was at this low here, remember this market was on a bearish market. It was going down, and since it was going down, you can see this one here. This is the, as that market was going down, this was the last highest zone that price was at before going where? To this down side here, to this lowest zone here. But now what happened to the next market? The next market went up to this high here. So since it went up to this high, it's what did it do here? It broke the previous low highest zone when the market was bearish, meaning what? This zone will be now called a higher high. This one here will be now called a higher high. Why is it called a higher high? Because it is higher than this last highest zone where the market was going on a bearish direction. So these are our higher high. Now the market came down to this low here, but when we compare this lowest point here and this lowest here, which one is lower? So this zone is low but not lower than this zone. So this zone is higher. This zone here is higher than this low, and we will call it now a higher low. So this zone here is higher than this low, and it is now a higher low. Then the market went up to this high. So the market came and broke this previous higher high. So now we'll be having a new higher high here, and that is why now this is our higher zone. So the market, this is now our higher high, and the market came down to this low. But when we compare this low and this low, which one is the highest? this is the highest compared to this higher low. So this will be a higher low because it is higher than this low here. So this is a higher low. Then the market went again high, breaking what? This higher high. So when this higher high has been broken, it is creating to us another new higher high. So this will be our higher high, and this zone here is was our previous higher low. So we want to see the market. We want to see this. If this, we want to compare this higher low here with this. So as you can see, this low is higher than this low, and this now will be our higher low. And then also we have this high, which is higher than this high, and also we have this low, which is higher than this low. So it will be our higher low, higher high. So when the market is going on a bullish direction, it is creating to us higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, like that. So these are higher high, higher low, higher high, higher low. We have the higher high, we have the higher low, like that. So when the market is on a bullish market structure, we want to see highs being formed. We want to see highs being formed. And I will take you to this, our new chart here. To this new chart here. So I want to draw. So there's our high. Then I'm just drawing. And then we will combine all the information that we will have to determine how we're going to trade these areas. So this zone here. So as you can see now, the market was at this low. We don't know if it was a lower low or a higher low. We are not going to focus so much on this. But now let's look at this high zone here. So as you can see here, we have no points to compare this high with. So we are going to leave it empty. Now here is now when we can start now the activity. Here, this low here is higher than this low. So meaning this one will be our higher low. Why? Because it is higher than this low here. So this will be our higher low. Then we can see here this high, this high here, the market went and it broke that high and it created another higher zone. So this will be our higher high. So this is our higher high. Then the market. So this is our higher high. And now, what about this higher low here? This one here. So this one here, as you can see, this was our previous low zone, but now this zone here is higher than this higher low. So it is still going to be our higher low. Then is our higher high, is our higher low, our higher high, and is our higher low. So this type of market structure is a bullish market structure. So when the market is going on a bullish direction, we want to see only higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. When are you going to be buying here? You will be buying at the higher lows. You will be buying at the higher lows. You will be buying at the higher lows only. You will be buying only at the higher lows. You'll be buying only at the higher lows. Why are you buying at the higher lows and not higher high? This is because if you bought at the higher high and the price retraced to this low here, you are going to be on a loss. But then now the market continue going up. So what is the need of you going to go on these lows? It's better to look for opportunities at where? At the higher lows. So you'll be looking for buying opportunities only at the higher lows, not at the higher highs. So that is making our rule number one. Rule number one is never never buy at the higher highs. So always when you are trading, never buys at the higher high. Only look for opportunities at the higher low. Why are we looking for the opportunity at the higher low? Because we want to buy at the cheapest price that we are not going to incur losses. Yes. So that is it for the higher highs and higher low of the bullish market structure. We want to look at the bearish market structure. And the bearish market structure is a market that is creating a series of lower highs and the lower lows. So it is a market that is creating a series of the higher highs. So we want to look at the bearish market structure. And when we talk about the bearish market structure is when the market is creating to us a series of lower lows and lower highs. We can identify this series by looking at the examples that are next on this presentation here. So just a minute. So when we say when we talk about the bearish market structure, is that we want to see the market creating to us a series of lower highs and the lower lows. Now it will confirm to us that the market has been going on a bearish direction. So this is an illustration of the British pound of the GBP against the US dollar. And as you can see here, this was our last high zone that we know, and this is the last low zone that we know. Now, you want to see the structure. So we don't want to mind a lot about what has been going on in the past there. We want to concentrate on this zone. So this is the higher zone, and this is the lower zone that we know. Now, as you can see, the next zone, the price went to this high. But when we compare this high with this high here, this high is lower than this high. So meaning this will be our lower high. Then now the market came down. The market came down to this zone here. So from the lower high and the market coming to this low here, this low here will be our lower low zone. Will be our lower low zone. Why is it our lower low zone? Because this zone is lower than this previous zone here, than this previous zone that was here. So this will be our lower low. Now we have this lower high. Why is this our lower high? This is because this high is lower than the previous high, and it will be now a lower high. Then here the market came down to this low here. So as you can see, this low here is higher than this lower low. So this will be our lower low zone because this low is lower than this low. So this will be our lower low. And then our lower high, lower low, lower high, lower low, lower high, lower low, lower high, like that, lower low, lower high, lower low. So how are you going to determine if that zone is still going to hold? Now let's look properly. The market was at this high here, and the market went to this low here. So this is our lower low. Now for it to confirm if that is a continuous of the lower low, the market has to come and break this low to create new lower low. So this will be our lower low. Then now for the lower high, the market has to respect the previous lower high, like that. So this is our lower high. Then the market came down, breaking this low, creating to us another new lower low. And then also the market did not went above this previous lower high, and that is why we have this lower high. And the series continues like that. So When we reach this point here, the market came lower low, lower high, then gave us this lower low. So let's look at this next. We are supposed to be looking for lower highs like that, isn't it? But now let's look at this one. The market came to this high, broke that lower high. So since it has broken that lower high and the market went to that high, what happens here? The market structure, the bearish market structure has been what? Broken. So you can just write, we will call now that zone break in the market structure. When this low high has been broken, it means the bearish market structure is no longer in hold. The market has changed direction and it is now going to go on a bullish direction. You see? Let me clear this. So once we look at the consolidation, then now we can still look at the market structure. So during the time of consolidation in the market structure, we will see there is essentially no higher highs or lower lows due to the market being in a balanced state. So if the market is behaving like this one here, the market moved to this high, it came to this low, moved to this high, consolidated, moved to that high, came down to this low, consolidated, came down. As you can see, you will not have a clear market structure here because what? If this could be your lower low, this is your lower high, then higher low. Because this low here is not lower than this low. Look, it will be a higher low. Then here, a lower high. Then what happened here? A lower, a higher low. Then what happened here? This high here is greater than this high, a higher high. So you can see there is no balance, there is no clear market structure here. Because of what? The market is just balancing itself. It's creating to us a lower low, lower high. Then again, it's create higher high, a higher low, a higher high, like that in continuation of the trend. So you can see that market will be showing us no clear direction. Now, I want to take you back. Now we can combine all the bullish, the bearish market structure together to form a clear thing. So the market, I'm just drawing and then I'll give you an assignment. The market went to that high, came to that high, then came to that low, then that one, then that one. Came to that low again, high again, then this low again, high again, like that. Then what happened next is that market came down, then to that high, then to this zone here. Now we want to try to understand. So as you can see here, we don't know, but this is the lower zone and this is the higher zone that we know. But now when we compare this low here with this low, what do we see? This low here is higher than this low, and it will give us a higher low. Then this high here is higher than this high, and it will give us a higher high. Then now let's look at this low here again. This low here is higher than this low, and it gives us a higher low, then a higher high, a higher low, then a higher high, then a higher low, then we have a higher high. But what happened next? Let's look at this higher low here. This higher low here, the market came, broke this low. So what do we have? There is change in that market structure. The market structure is no longer bullish. The market structure has been broken, and we will call it a BMS, break in the market structure. So the break in the market structure occurs here. When the higher low has been broken, we were expecting a higher low here. If the price could come and reverse from here, this could be a higher a higher low. But that did not happen. The price came down, broke that higher low, and it went down to this low here. Now, when we compare this low and this next low, which is lowest, this low here is lower than this low, and it will be our lower, and it will be our so this is our break in the market structure. And now the price came down, creating to us a new lower low, meaning now the structure has changed and the market is now going on a bearish direction. So since the market is going on a bearish direction, we want now to, this is our higher low. That zone is our higher low. No, lower high. Sorry for that confusion. So this zone here is our lower high. Now, when the market is on a bearish direction, we will be looking only for opportunities to sell at the lower high. We're looking for opportunities to sell at the lower high. So since the market came, gave us lower low, then lower high again, we will be looking only for opportunities to sell at this lower high. So our selling opportunities are at the lower high. So that is how you are going to be trading. So whenever you have the break in the market structure, you will not sell immediately. You will wait for the price to create for you a lower high, so that you can now enter your sell position here and wait for the market to hit where your take profit will be. Thank you so much for joining this class. Kindly remember to subscribe, share, and like our page. Thank you so much.